Thank you for joining me on this episode of Doing Insurance Right. My name is Scott Jenkins. I'm your host. I'm a local farmers insurance agency owner here in Phoenix, Arizona. And today I just wanted to revisit the home insurance and possibly what you could look for in your home insurance proposal. We've went over what the main coverages are in previous episodes, but so basically you're going to have a few different what they call coverage with letters beside them. So like coverage A is going to be dwelling amount. This seems to be a really popular question these days. Here in Arizona, the price of homes is well above what the dwelling amounts would be. So the dwelling amount just refers to the amount of money that it's going to cost to rebuild the structure if it's a total loss. So for example, let's say you have a 3,000 square foot home and we're pricing it at $200 a foot, which would come in at $600,000. That's what the estimate is in order for us to rebuild the home if it was a total loss. Now, that same house could be worth $900,000, $1 million, maybe $700,000, somewhere in that range. But the reason for that is because of location, the land or lot that it sits on, and then also the market right now is extremely hot. So it can also be the other way around. Let's see the market went extremely cold. We'll still build that house at 600,000, but let's say now your house is worth 550. It's still going to cost $600,000 to rebuild the house. So technically, it has nothing to do with the price of your home. Now, you want to make sure that we're accurate on bathrooms, bedrooms, flooring, one story, two story, 1.5 with an attic, a finished basement, attached garage, things of that nature. But the dwelling amount is just going to refer to that, to rebuild the house. The second one is going to be coverage B, or what they call separate structures. That's going to be like a detached garage, a shed, anything that's not attached to the main living area of the main quarters of the house. Or if you have some people have a detached living area, maybe like a mother-in-law suite, something to that effect. That's what separate structures is going to cover. Coverage C is going to be personal property. A couple things to look at here. That's going to be personal property at full replacement cost, or personal property when it does not say replacement cost. That means that it's basically going to be evaluated with depreciation. So I'll give you an example. So let's say you bought a TV 5 years ago. If you have replacement cost on personal property, it's just going to be the price of whatever the new one is. So for example, let's say you paid $2,000 for that TV. Now that TV's $1,500, or maybe it went up and it's $2,500. So a replacement cost is going to give the value of that at the current market. ACV, or non-replacement cost, is going to involve, you paid $2,000 for that TV. It's 5 years old. Let's say it had a 10-year shelf life. Now it's only worth $1,000 in that way. So that's something to make sure you keep your eyes on when it comes to that one, on coverage C, personal property. Coverage D is going to be your next one. That's going to be loss of use. So, for example, if the house is not inhabitable because of a peril, for example, the house caught fire, the roof got ripped off, whatever it may be, that loss of use account is the actual amount of money that's set up for you to live elsewhere while that's going on. So you want to make sure approximately it's going to have at least in Arizona, 12 months worth of money for that. So you can figure probably $5,000 or so, depending on lifestyle, of what we're going to need in order to make sure to put you back to whole somewhere else to live. So you want to make sure you probably at least got $60,000 worth of coverage there. If you have a lot nicer house, or you have a lot more people living with you than just maybe a couple, you might want to make sure you've got a little bit more coverage there. Next one is going to be medical payments to others. That one's pretty self-explanatory. If somebody gets hurt at your home, that's the amount of money. Sometimes you're going to see either $1,000, $5,000, might be even $10,000 worth of coverage there. There's not typically a whole lot in that category, but you do want to make sure you have at least the $1,000 minimum. The last one I wanted to kind of get into is personal liability. This is your getting sued account. We've talked about this before. Typically on the home, it starts at $100,000, goes to $300,000, $500,000, $1 million, and possibly even $2 million. If you have a pool, I'd recommend at least getting $500,000 because accidents tend to happen a little bit more with the pool on that end, or attack that account. If we have animals, making sure those animals are covered under the personal liability, and making sure the breed's correct, just updating that policy. There's going to be a lot of other things that you can see on a homeowner's insurance policy, such as backup of sewer and drain. So if you had a water flow backup with the sewers, There's going to be other endorsements as well that you're going to see. So if you're in a condo or a townhome where the HOA takes care of the outside of the building, it's going to be what they call association loss assessment. That's going to range anywhere from $1,000 to $50,000, depending on your HOA. So, for example, if the outside of your house burned, right, the HOA is going to be responsible for the outside. You're going to be responsible for the inside. Well, the inside you've got coverage for on your personal policy. What that HOA loss assessment basically covers is the deductible on the homeowner side in order to keep prices down insurance wise for the whole community. There's also going to be increase in jewelry available, increase in firearms, silverware, gold ware, things of that nature. Basically, any high ticket item that you might have personal property wise in your house might need an individual policy on the homeowners to cover the full amount. So if you have some higher dollar things like watches, rings, necklaces, or guns, or anything of that nature, let's make sure we take a look at that and make sure if you want to have that additional coverage to cover that particular item. Wedding ring seems to be a really popular one on there. So just something to keep in mind there. You're also going to run into like what they call service line endorsements. So basically any service line, power, cable, anything coming in, water coming into the house, utility line, that coverage is also going to be available to make sure that any of those lines would be taken care of up to a certain dollar amount. So let's say the city has old lines coming into the house, which happens all over the place, to make sure that there's coverage there and that the city doesn't pass along the cost to you, that you can actually make a claim on your homeowner's insurance for. One thing I did want to go over with homeowners insurance, though, and this is extremely important, you need to make sure that you're not reporting everything that possibly could go wrong in your home. Remember, you do have a deductible, whether it's $500,000, $1,500, $10,000, 1%, 2%, 0.5% of the dwelling amount. You want to make sure that you're using that wisely. Reason is I see a lot of people that have maybe a $1,500 deductible and they call in a claim and the total amount of the claim was $2,000. Well, you're going to be responsible for $1,500. The company's going to pay $5,000. The problem with that, though, is when we do make a claim, obviously there are surcharges on your next renewals, whether it's with us or with a different company. So you want to make sure that you're not going to the claim's only going to be for $500 that we're going to pay out for, because the home claim's going to stay on your record for 6 years. I promise you will pay more than $500 in surcharges over 6 years. So a good rule of thumb normally is double the deductible, and then it's something we probably need to consider. Also, you're going to need to get an estimate. So unless the house is on fire, we pretty much know, and the house is livable, we're going to need some sort of estimate to kind of gauge on that. Whether it's flooring, water damage, water heater exploded, whatever it may be, we do want to make sure that we get that, we want to get that looked at first. That way we can make an educated decision on what to do next. Whether to call in the claim, have the adjuster look at it, or to not call in the claim. So just keep that in mind when you're looking at that. Now, with AAA, rated insurance companies like Farmers, you're typically only going to get 2 claims within a 3+ year period without getting either what they call non-renewed, or if you're looking to switching companies, Farmers is not going to be an available option for you. So keep that in mind as well. So if it's only been like 12 months since your last claim, we really need to look hard at that just to make sure that, it is a big enough dollar amount in order to turn it in as a claim. It's just looking out for you and your best interests to make sure that you have options available to shop, look around at different companies, things of that nature. I just don't want to see you be shut out because we made a few too many claims on that. So I did want to thank you for joining me on this episode of Doing Insurance Right. As always, if you could rate, review, or subscribe to whatever great platform you're listening to us on or watching us on, whether it be Chrome, or either it be Apple, Spotify, iHeartRadio, or any of the other ones out there, I greatly appreciate it. And I look forward to talking with you on the next episode.